Welcome back to the second segment of this week's Top Stocks Picks podcast. My guest on this week's show is Eric Coffin, and his second top pick this week is Vendetta Mining Corp. Symbol in Toronto is VTT, and you can buy it down here in the States as I have under the symbol VDTAF. 79.5 million shares outstanding, recent price in Canadian dollars around 23 cents, giving it also a very small market cap, about 18 million. And Eric, you know, this is a zinc play, and as you've pointed out in the past, the period of time to profit from these zinc plays is oftentimes very short. So you latched onto Vendetta, as I understand it, in part because you saw the window as an opportune time window for this company to make some money in an up zinc market. I think zinc has been behaving a bit better. It's looking very promising from a supply and demand point of view. Their project is a Pegmont project in Australia. What can you tell us about this? And first of all, let me ask you about the zinc markets. Where do you think we're at in that cycle for zinc now?
I'm still pretty comfortable with zinc. I mean, there's definitely right now there's currently a supply deficit. There are really no big new mines coming on stream. There's one in Namibia that's slated for next year, but that one sounds like it's going to be almost like a closed circuit thing where the buyers are pretty much lined up for the concentrate already. It's also an oxide. It's got some issues with high cadmium and things like that, so it's not going to be an easy one. Other than that, most of what's coming on stream is pretty small. I mean, 50,000 tons or less a year, which is small for a zinc mine. We've lost 2 or 3 of the world's largest mines that just run out of ore last year. The big, if there's an 800-pound gorilla right now, it's probably Glencore. Glencore shut down 500,000 tons a year of zinc production early last year when the zinc price was horrible. They haven't brought any of that back on stream, and certainly the way I read comments that I've seen recently from Glencore, I don't think we need to worry too much about Glencore spoiling the party. The zinc price has gone up about 60 or 70% since they made that decision. And what that means is Glencore is actually making more money mining 500,000 tons less concentrate than they were before. And what we'd certainly like to be making the money from those mines that they shut down. They've made it abundantly clear to the market they're not going to screw things up and they're not going to restart unless they're comfortable that anything they bring on can be easily absorbed. And if you assume Glencore is going to stay out for a while, we're going to have fairly substantial supply deficits here for the next 2 or 3 years. I mean, normally these zinc cycles, they can have big runs, but they tend to be short. This one feels to me like it's going to be longer. I think we could have a 2 or 3 year run here. I won't be shocked if you see a $2 zinc price in the next 12 months. I mean, because when it goes, it tends to really go. The other thing, too, if you look at one thing that a lot of people monitor when they're watching base metals is what's called the TCRC charges, and that's treatment and refining charges that smelters charge the miners. I mean, few, if any, miners have their own smelters. They produce a concentrate and sell it to a smelter. And you get a pretty good feel for who's got the bargaining power by how much they're charging for those, for the refining. And right now, the TCRCs have dropped from early last year. They were probably in the order of $120 to $130 a ton. They're down to $50 or $60 a ton, and there's reports that as low as 20 or 30 in some places in China, where you have smelters that are really desperate for concentrate. So, I don't see smelters offering those kind of deals unless they're genuinely finding it very, very difficult to get concentrate. So, I think that's as good an indication as any that the market is, in fact, as tight as we think it is.
All right, talk to us a little bit about the Pegmont property and how near is this project to production, and give us some idea about the economics, the size, and so forth.
They picked it up about 3 years ago, like everybody else. They had trouble raising money in a bear market. They did manage to do a raise last year. They did a bunch of drilling. They changed, in a way, it's similar to Atamara in the sense that part of what changed here is that the company has changed the geological model. It went from being sort of a single horizon lead dominant model to what's called the Broken Hill model. And Broken Hill is named after the Broken Hill mine in Australia, which is the world's largest lead zinc deposit. And it's also the reason why the company name BHP, that's actually short for Broken Hill Proprietary, based on the mine. This is in northeast Australia, and this area is actually the largest lead zinc mining camp in the world. Pegmont is surrounded by several operating mines right now, the largest of which is Cannington. Cannington's operated by South 32, which is a BHP spin-off, actually. They started out with about a 4 million ton deposit. They did a bunch of drilling last year. They determined it was Broken Hill model. They used that to sort of retarget. That retargeting was successful. They drilled a lot of pretty good holes. They started metallurgy last year. Metallurgy is always critical for base metals. They put out met results at the beginning of this month. Those results were quite good. They were able to create both lead and zinc marketable concentrates. They should get even better recovery numbers when they do what's called open cycle tests. The ones done on the lab bench are closed circuit. But there don't seem to be any nasty deleterious elements or anything. They're going to start drilling again. There's quite a wet season in this area, but that's done now. They're planning to have the drills moving in later this month. They want to do a major program this year. What they're hoping to do is get it from the current size, which we should know what that is in the next month or so. They said they were going to put an updated resource, but I'm expecting 7 or 8 million tons in that range. And what they're targeting is 12 to 15 million tons. That's big enough that a buyer could do, say, a 1 million ton a year operation for 10 plus years. And back of the envelope, and these are, I stress these are back of the envelope numbers.
Sure.
I think you would have an NPV in the order of 200 to 300 million, because you're looking at relatively high grade lead zinc. Zinc's had a big run, but actually lead's not doing that bad either. They're both pretty good prices. If one of the nearby mines, like Cannington, which isn't that far away, bought it, I assume what they would do is simply throw the stuff in trucks, because they've got quite a large mill complex already. I don't think they'd build a mill. So that would obviously be a much lower capex proposition. There's another nearby mine, even closer, so it's 25 kilometers away. That one was actually built for a copper ore body, but they too that one's on care and maintenance. I don't think it would take much for those guys to adjust their mill to put in zinc circuits, and I think if it was big enough, they'd be tempted, because they paid a fair amount for that mine, and it didn't work out for them. They need something to offset the costs. So I think if these guys can get to PEA by year end, that's sort of what I'm hoping for, and they can bring it up to that 12 million ton range, I think odds are pretty high that this company isn't around a year from now. To me, it's just one of the most obvious takeover candidates, because it's one of the few zinc deposits I see that is in a position to actually be mined this cycle. And I assume those ones get picked off first.
Yeah, sure. And with a market cap of 18 million, you would think that fairly tightly held. This one is, I believe, fairly tightly held. Eric, correct me if I'm wrong, but I believe
No, it is pretty tightly held, because there's the last placement. Most of the stock is from the placement that was done last summer, and there were essentially two big buyers for that. One was a fund out of the U.S., and the other one was actually Solitario, which is actually a base metal developer, and then management itself has about 10%. I think those three entities between them probably have something like 30 or 40% of the stock. They've got a bunch of warrants out. Some of them have been exercised. What's left is almost all held by, again, management or this gold fund, this mining fund, or Solitario.
Yeah.
I think that the reason it's kind of flattened out in the last few weeks is everybody knows these guys need to do another placement. When they did the placement last year, I think management's working hypothesis was the people bought that placement. It was kind of an unwritten, and maybe should have been written, part of the deal that the people who bought that place, and when the time came, they would turn around and exercise the 10-cent options, and that would be the money for the next big drill program. A lot of the retail guys have exercised, but the funds are saying, we kind of like the optionality, so we'd like to sit on it for now.
Yeah.
So these guys they're getting impatient. They don't want to slow down the momentum. So I know that management's out there right now working on financing.
Mm-hmm.
I know from my own contact, I know at least two of the groups that are talking to them. One of them is the one I'd like to see do it, which is I suppose they're a hedge fund. That's a good description. Out of England. They're fairly well known in the sector. They've got a reputation for paying a good price for things because they're not guys they're not traders. They don't buy placements so they can trade the stock. They buy placements. They're buying a piece of the company, and their expectation is their end game will be a takeover.
Sure.
And I'd like to see those guys do it, but I know that group. One problem with them is they're really, really slow. I mean, their due diligence process is just painful as hell.
Yeah.
And I know they've been going back and forth with those guys for a couple of months, but my sense is we're going to see a financing here pretty quick because I talked to the chairman last week, and he said, look, I've got guys out of Toronto and New York in my face to do a placement too, and as much as I'd like to do with these guys in London, and they're my first choice, I can't wait around for these guys any longer. So
yeah.
I think you're going to see them do a placement. Maybe it will be with the guys in London. Maybe they'll finish their due diligence. But basically, he said, "Look, I'm not going to wait for these guys because I don't want to hold things up. I can start moving drill rigs in a couple of weeks, and I really want to get going there." So,
any idea, any sense of how much they'd be looking to raise now, Eric?
I think if they were doing if they had their druthers, they would probably do $5 million, but I don't know that they would do $5 million at this price.
Mm-hmm.
I think unless they were doing, if they were doing a placement with these guys in London, I think you'd see a placement that was at least at market, if not above market, and there would be no warrants or anything.
Yeah.
So because, like I said, these guys are buying a piece of the company, they don't care about that stuff.
Yeah.
If we're doing a placement with, a different fund or a bunch of brokers, brokers are brokers. They're going to probably want to do it at whatever, 20, 21 cents. I don't think management loves the idea of doing $5 million at that price at all. I think they would probably do a couple of million and get going on the drilling, start putting out drill results, get out the resource, which I believe they're working on, and then use that as a springboard to raise some more at a higher price. I think, round numbers, I think $5 million is kind of the number they're thinking of to do this year's drilling and do a PEA.
Mm-hmm. All right. Anything else about Vendetta you might want to add?
I really like the man. I've known management for a long time. I didn't know the guy who's CEO who's running the program. I've been very impressed with him because he laid out, when they started last year's drill program, he laid out his logic and why he thought it was Broken Hill model and what that meant for, being able to chase these zones. And I got to say, the guy pretty much hit things exactly where he thought he would. And it's not like a simple deposit. It's being, part of the reason why it works is that it's being folded, which thickens the zones, but those folds make it a lot harder to chase. And it was pretty impressive how close, bang on, really, Peter was with a lot of these holes in terms of hitting the ones. He seems to have this thing worked out. The other thing I should mention, I don't know whether it means anything or much at this point, neither does management, but part of Peter's resume was this copper project that's sort of the nearest mine. He's one of the guys that has credit for discovering that. Late last year, they drilled one hole a couple of kilometers away from everything else, and Peter told me it was drilled as an assessment thing, like they had to spend some money on that specific claim, so they basically took a drilled a hole with an IP target. And they hit this copper zone, which wasn't bad. I'm going from memory here, but it was in the order of 10 meters or percent half copper or something. Mm-hmm. But it's not the same. It's not part of the Pegmont deposit. It's not even the same model. Mm-hmm. It's the different model that is the same as this mine 30 kilometers away. And Peter told me, he said, look, it's one drill hole, who knows? Yeah. But part of what they're going to do, I think at the start of this field season, is a bigger IP program in that area, because I think what got Peter excited about it is he said, look, I don't know whether this thing goes anywhere. We don't know anything about it. It's this tiny little anomaly we started to drill a hole on.
Yeah.
But if that's something real, he said, if I've got a zone that's the same model as the guys down the road, and, his comment was, if I found even a couple million tons of this stuff, the guys next door would probably pull the trigger because they're screwed. They've got a mill and nothing to feed into it, and a liability. And his feeling is that those guys next door saw not only Pegmont, but this other zone that they could start mining essentially right away and dump right into their mill 20 kilometers away.
Yeah.
He said, I don't think we'd be around very long.
Oh, that's another possible bonus there on the project, I guess. Do you think they'll spend any money on that at all, Eric?
No, they aren't. Yeah, he's definitely, he said they're, one of the first things they're going to do, just because it doesn't involve, messing up the roads, is they'll get an IP crew in there. They're going to do IP in that area. And he said, if we see a viable looking anomaly, we're definitely going to put more holes in it, because he thinks that potentially has a lot of value. And I guess more to the point for him, in his mind, it brings in an obvious second bidder. And, in situations like this, there's no pretense from these guys. They don't want to build a mine. They want to build a thing.
Of course, yes, right.
The more bidders you've got, the better.
Yeah, absolutely. Well, I thank you very much, Eric, for helping us understand two companies quite a bit better, and I think it's really great. I look forward to talking to you about some more in the future. But before we say goodbye today, I'd like to ask you to just let our listeners know that there is another Metals Investor Forum event coming up too, right? You want to talk about that just for a moment?
Yeah, the next one is on the 5th and 6th of May. Usual location, the Hotel Georgia in Vancouver. Great venue for these things. Several esteemed speakers, including, of course, you, Jay, will be speaking there, and everybody's got a few favorite companies that they want to have the attendees listen to. I mean, it's mainly our subscribers and people off our list that go to these shows. And I didn't pick Adam, Aaron, Vendetta by accident. I mean, obviously I like them both, but they're also both going to be presenters at the next Metal Investors Forum. We have got pretty good RSVP numbers already, and we really just started getting the word out. And like, I haven't sent it to my broader list. I've only sent it to one list, and I think that's the same for most of the guys. I think if the last one's anything to go by, we'll be closing the list, potentially well in advance of the show itself. So if you're interested, I would go to metalinvestorsforum.com or go to Jay's website. I think you've got a link on it.
Yeah, I do. People just click on there and it will go right to that website and you can sign up for it. I would really urge people to do that, because there were people I know that got frozen out the last time. It is a limited size venue, and it's limited in size, I guess, Eric, for a reason. You want to keep the quality high here, and you don't want to just have, just because people have some money in their bank account doesn't necessarily give them the ability to come in and participate in this. So they are chosen by the newsletter writers, and they are favorites of the newsletter writers, which I think really adds to the quality of it, Eric.
Oh yeah, no, it's definitely a curated list. It's not first come, first serve. We turn companies away every time, actually, either because, the main reason is that they're simply not followed by one or more of the newsletter editors, because we only have paid subscription newsletter editors giving talk, and for a company to be able to present, they have to be followed by at least one of those newsletters. So I've probably turned 8 or 10 companies away already.
Yeah.
The same thing happens with the audience. I mean, the first people we go to get attendees is the subscriber list and the broader list that we all have. And, we're going to give those lists priority. And, we're not trying to make this a giant show with 500 companies and 5,000 people. I mean,
right.
Very intentionally keeping it. The maximum number of companies is 30. The maximum number of attendees on a given day is about 400. That's how much we've got room for. And of course, we do feed everybody. We do open a bar up for everybody both days. That costs money too. But I mean, it's mainly that we're trying to have a quality on both sides of the stage, if you will.
Yeah.
Selected companies and selected attendees too.
Yeah, excellent. Well, it is great, and something I really look forward to. It is the best event of its kind that I've been involved with in the 35 years or so that I've been around this business, Eric. I want to thank you and Scott for pulling it together. Scott Gibson and yourself, you were the guys that made it happen. So thank you very much, and we'll look to talk to you again sometime in the near future, Eric.
Yeah, well, thanks in advance for being one of the speakers, Joe. That's the reason it's such a good show.
Well, thank you. That's very kind of you. But I must much prefer sitting back in the audience and listening to yourself and others than getting up there talking myself. I learn a lot more by keeping my mouth shut and my ears open, Eric, and that's what I've done today with you. Thanks so much again for being our first guest on this Top Picks program. Well, that's it for this week's Top Stocks Picks podcast. Next week, I expect to have with me either Brent Cook or Joe Masmander, or perhaps both will join me at the same time. I hope that you will join me next week for next week's Top Stock Picks podcast.